Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, we break down the biggest market catalyst for investors from trade progress to the May jobs report. Plus, we'll bring you the outlook for rate cuts this year as investors look for signs of weakening economic data. And Elon Musk pushes to kill President Trump's tax bill. We're going to break down the hurdles it faces in Washington and what this could mean for the U.S. economy and your portfolio. Half an hour into the start of U.S. trading, let's get you a check on the markets. Taking a look at the major averages, which opened in the green but have since turned negative. You got your S&P 500 off about 0.2%. Same with your tech-heavy NASDAQ. So it was really interesting to see the market kind of moving to the upside, ignoring a little bit of the weaker than anticipated jobs data that we got in. And then we had headlines of President Trump and Xi Jinping talking. We saw that lifting stocks as well. But now you've got stocks moving back to the downside just a bit. But let's flip over to the bond market here. I want to take a look at what we're seeing with your 10-year yield down about 2 basis points. The longer end of the curve continuing to take it on the chin even more is down about 3 basis points here as traders boost bets on Fed cuts after some of that weak economic data. Initial jobless claims jumping to 247,000 for the week ending May 1st. That is about 17,000 job claims above the estimated number. For more on the market's reaction to this weakening economic data, I want to bring my co-host for the hour. We got Mark Malik. He is Siebert Financial's Chief Investment Officer. And joining us outside the studio, we've got Jeffrey Roach. He is the Chief Economist at LPL Financial. Thank you both for being here this morning. Jeffrey, I want to start with you. The highest 2-week jobless claims numbers in more than a year. Not a massive uptick, but how worried are you about the labor market right now?
Well, the labor market is certainly quite mixed. We're seeing some mixed signals from just pretty much every report out there. So, for example, yesterday, Beige Book from the Fed, a little bit mixed on labor demand. ISM services, same. Not all gloom and doom, though. And then, of course, the most recent, as you just referenced, this morning's initial unemployment claims. I tend to look a little more on continuing claims. Do think that we're starting to get a little bit more cracks showing in those high-frequency labor numbers.
And Jeffrey, sticking with you, how does that impact how you're thinking about the jobs report this Friday?
Well, we're probably going to see a little bit more weakness coming out of the federal payroll section of the report. Probably see a little bit more weakness in leisure and hospitality. Probably a little bit more weakness in construction hiring. But I think you're going to see continued stability in things like financial services, some of the other professional services. I think if we hover around, say, 110 gain for the month, and if the 3-month moving average stays above 150, it actually could provide some salve for the markets, I think.
And Mark, I want to bring you into the conversation. So the economy, as Jeffrey describes it, is slowing, but not necessarily slow just yet. Can investors afford to look past the slowing of the economic data that we've seen?
Well, it's all about how much they've been slowing. It's clear that they have been slowing, so the trends are certainly in that right direction. Yeah. And investors should not and cannot ignore it. However, in terms of how badly they're trending down, that's a little bit of maybe some cold comfort. And of course, we also know about that. Ultimately, the Fed is watching, and the Fed will be watching that number. So knowing that the Fed might act if they see any extreme moves in the labor market is probably providing some more, at least lifting the markets or holding markets up a little bit.
So how big of a catalyst might a Fed cut coming sooner rather than later be for this market?
Well, it would certainly be a happy pill for the market. A lot of the challenges that we're all looking at for the markets right now, unfortunately, lower Fed funds rates are not going to necessarily help any of those challenges. However, markets ultimately always like lower rates, and clearly, if the Fed did do something, it would certainly send a positive signal to the market and maybe improve sentiment in the market.
Jeffrey, I want to bring you back in on exactly what Mark was just saying. What would it take for the Fed to cut sooner rather than later? How bad would the economic data have to look?
Well, I think the Fed is really focusing on these nagging inflation pressures. I referenced just a little bit ago the ISM surveys report as it relates to employment. From the most recent ISM report on business that we just got 2 days ago, input costs are still rising pretty significantly. So that's a real concern. So the Fed is in the wait and see mode. Interestingly enough, it's possible that firms are in the wait and see mode too as well. Going back to labor market numbers, it seems as if firms are not interested in necessarily adding strongly to payrolls, but they're also conversely not really interested in shedding payrolls. You don't really see the firings increase as well, right? The hirings and the firings, they're kind of static at this point. Wait and see. I think back to the original question here on when and if the Fed will act, they're certainly not going to act in this upcoming meeting. There's a chance that they actually hold in July as well if the inflation numbers are still elevated and payrolls continue to show some stability.
Mark, do you agree with that path forward for the Fed?
Yeah, I think so. I think, our base case is still about 2 cuts for later on this year, although there was a little bit of a bump the other day in Fed funds futures. We saw that as a result of the numbers that we got the ADP numbers. But I think at this point, they could afford to wait, and I think that's the mode that they're in. It's interesting, though, if we look at some of the behind-the-scenes commentary from the Fed, such as the Beige Book, and also we saw the meeting minutes earlier in the month. There are concerns amongst the Fed, although whether they act on them now or later, it's more likely going to be later, and we're still focusing on 2, even though the market's starting to inch into possibly 3. When we look at futures, at least.
And talk to me about how that impacts your view on the market right now as a CIO. Like when you think about the Fed being concerned about the economy, obviously the tariff mentioned skyrocketing on earnings calls. What would give you the most peace heading into your summer vacations, heading into the second half of the year?
Yeah, interestingly for me, it's with the Fed, it's less about the rates and it's more about what they're saying. For me, I'm always looking for their acknowledgement what it is that they're watching, right? The market wants to know what is going to be that catalyst that moves them to cut rates. And it's not at all clear at this point, right? So they're kind of giving us the impression that they're being complacent. And we have seen the Fed be complacent in the past, and it didn't work out for us. So I think for me, I'd like to hear more about what their thoughts are. Obviously, the next Fed meeting, we're going to hear the FOMC meeting, we're going to hear more. But that's the stuff that I'm watching really closely.
More so than tariff policy, or how would you rate the 2?
Oh, absolutely. Well, tariff policy is the top, right? So the Fed is sort of bubbling into the discussion now that we've had a couple of bad prints in employment. But of course, tariffs are going to drive everyone, and the Fed as well. The Fed is using that as an excuse to sit back and wait. So the more progress we make on the tariff front, the more knowledge we get about what they're actually going to look like at the end of the day. I think that is, of course, the main catalyst that's driving us all today.
Great overview, Mark. Thank you. And thank you, of course, to Jeffrey Roach for joining the conversation. Mark Malik, you're going to stick with me for the hour. Well, the Trump-backed budget bill has a major critic in Elon Musk, the former head of Doge, going to social media to express his frustrations, writing in a post on X that the bill, quote, more than defeats all the cost savings achieved by the Doge team. Elon Musk's biggest concern being how much the policy initiatives could balloon U.S. debt. Musk calling for Americans to contact their representatives and ask to kill the bill. Congressional Budget Office is estimating that the budget bill could add $2.4 trillion to the deficit over the next decade. On the other hand, in a separate report, the CBO is saying Trump's tariffs could reduce deficits by $2.8 trillion over a decade if they remain the same. Some insiders say that Elon Musk is really upset about the EV tax credit cuts. According to Axios reporting, Tesla spent at least $240,000 lobbying for the credit as of late April. House Speaker Mike Johnson and Senate Majority Leader John Thune have both rejected the possibility of killing the budget bill. Coming up here, we're taking a look at some of today's trending tickers. We'll give you the news behind those stock moves next on Catalysts. It's now time for some of today's trending tickers. We are watching Wizz Air, Citi, and MongoDB. First up, Wizz Air plunging after its annual operating profit fell more than 60% from a year prior. The European budget airline weighed down by plane groundings and high costs. Wizz Air is one of the carriers that's been forced to temporarily ground some jets because of required repairs. You can see they're down over 25%. Mark Malik still here with us. Mark, what do you think that a move like that in this name is kind of a signal for the broader sector?
It is absolutely, it's current to the news that we're all watching today, right? Managing prices and managing costs and cost rising, right?
Yeah.
When you're talking about airlines, especially airlines like that, where you have very thin margins, it's very easy to get tripped up. They have to worry about fuel costs, and fuel costs, whether they're rising or not, they have to constantly be hedging that. And if they're on the wrong side of that hedge, that's an additional expense. It's a challenging business to be in. And some of the airlines we're going to see similar implications in other airlines, I'm sure. Going to watch it.
And to your point, especially the budget airlines that have those slimmer margins as well.
Indeed.
Next up, let's talk about Citi announcing plans to cut about 3,500 tech jobs in China as the bank continues to reduce costs and streamline global operations. The cuts are expected to be completed by the beginning of the fourth quarter. And of course, this isn't the only headline we've gotten today about layoffs. We also had news of 15% of the staff at P&G getting cut. Mark, does this signal something to you that's specific to the finance sector, or is this just an individual company decision for Citi?
I'm going to say something controversial if I can. The jobs that are being cut are IT type jobs. Mm-hmm. And I think we're going to see a lot more of that across the board going forward because of AI, right? So AI is making IT folks much more efficient these days, and you see them using it more and more across the board. Mm-hmm. And so you see, when you had 3 or 4 developers, now you can maybe get away with 1 developer. Not making a big broad judgment on that, but it's a reality. I hear it more and more. Everyone I speak to, every company is employing it to make their programming and developing more efficient. So this is most likely related to that. Yeah,
not just Citi then cutting these jobs, not just the financial sector potentially cutting these jobs, but we could see this more broadly as we see an embrace of AI technology. Yeah. Well, finally here, speaking of AI, let's talk about MongoDB surging after raising its full-year revenue guidance. The database company also reporting better than expected results for the first quarter, with revenue up 22% from a year earlier. Those shares up nearly 18%. Mark, how are you thinking about this name?
Well, that's just playing into the thesis that we've been discussing together for a long time, which is, again, this AI infrastructure build out. This is just another one of those companies that's going to continue to benefit as this industry grows and propagates. As we talked about earlier, it's not just America anymore. Now sovereigns are developing data centers and so on. And all of these components are going into that AI infrastructure. And so these types of jumps that we've seen and this type of forward guidance increases when, on the other hand, you're hearing many people pull back their guidance. This is just, again, supportive of our thesis that the big growth opportunity still remains AI and the ecosystem around it.
Yeah, and that thesis you got to have conviction on regardless of the kind of volatility that takes hold in this current market. Mark, thank you so much. Appreciate it. For our audience, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, President Trump and Chinese President Xi Jinping spoke on the phone early Thursday, according to Chinese state media. The long-awaited call could be a sign of progress in trade talks between the nations. Yahoo Finance's Ben Merschel is here with us now for the latest. Ben, great to have you break this down for us. What do we know?
Well, good morning, Madison. We don't know a lot so far. What we have is a bulletin from the Chinese side. The Trump team has not confirmed this call yet or offered any details. And the Chinese statement is a single sentence long. All they're offering at the moment is that the call did indeed happen and that it came, intriguingly, at Trump's request. This is a message we've been hearing from the Chinese all week, essentially, that Trump wants this more than the Chinese do, kind of as a positioning matter here. But it does come as there's huge issues on the table and a sort of 90-day trade deal with China that's has appeared to be increasingly in jeopardy in recent days, especially over issues like critical minerals. That's one that the Trump administration is accusing the Chinese of cheating. So we're waiting to see if Trump repeated these claims in his call with Xi and what the response was there. The Chinese side has countered with their own claims of cheating on things like semiconductors and AI, cheating the agreement that was reached in Geneva last month. So a huge amount of issues on trade issues on the table, as well as military issues that the two leaders have to get into. We're just waiting to get more details on exactly what they got into and any resolution that might be there. But the overall sense here is this is hopeful for kind of a reset in Chinese trade relations that have been in trouble in recent days, and hopefully kind of getting back on track. What Treasury Secretary Scott Bessent has called stalled trade talks.
Ben, amazing overview as always. Thank you so much. I'm going to stick with Mark Malik to get a little bit of a reaction. Mark, one thing I'm interested in is this idea that the stock market is post-tariff uncertainty. Like they've already priced in that these tariffs are not going to be as bad as originally anticipated. We're obviously up year to date now. To what extent do you think that we could see the market continue to rally off of headlines like this conversation with Trump and Xi?
I think you can. I think the general overview, as you said correctly, is that the market definitely has priced in the current environment, what's here now. I think the market's expecting at the end of the day, when all's said and done, we're talking about a blended tariff rate around 10%, still higher than it was last year. But I think everyone's sort of getting good with that at this point. And in terms of the negotiations with the big negotiation with China, which is clearly the most important one, I think that one is going as we would expect, right? This is the typical back and forth that we had in the last trade negotiation with China back in 2018, 2019. Yeah. So we expect this sort of rhetoric going back and forth, that, he said, she said, kind of situation. And we're going to see more of that posturing. But they will come to a conclusion because it's in their best interest, in China's best interest, in the U.S. best interest. And we have to bear in mind that it took 631 days to come to the last phase one agreement. And so we're just in early days of that. So I think we're going to see more of this back and forth, and the market is probably already prepped for that, right? Because we've seen it before and we kind of expect it. So as long as there are no real crazy surprises, I think we're sort of a little bit past that at this point.
All right, Mark, from your lips to the vacation god's ears for investors who are planning to go on vacation this summer, thank you so much. We're going to have all your markets action ahead here on Yahoo Finance. Stay tuned for more. The dollar is on a historic losing streak as the currency faces headwinds from President Trump's tariff and tax policies, as well as weakening economic data. So what does the decline in the dollar mean for U.S. stocks? Joining us on that, we've got Christian Lawrence. He's the senior cross-asset macro strategist at Rabobank. I've also got my co-host for the hour, Mark Malik, still here with us. Christian, it's great to have you on here. We've talked about this before, but just taking a look at the U.S. dollar year to date, I mean, still down over 9%. To what extent does that put a cap on how much we can continue to see stocks rally this year?
Yeah, well, I still think US assets are attractive in general, but without a doubt, we have had this sort of sell America moment, but I think that that's really coming from quite extremes. And, even when you think about the dollar, at the back end of last year, the long dollar was very much a consensus trade. So positioning was very stretched. Yeah. So to see this sort of a pullback, I think is natural when the facts change, essentially. I mean, the dollar is down, as you said, 9% year to date. I think the smallest loss against any G10 currency is about 5%, and that's the Canadian dollar, which of course has been struggling as well. Yeah. But I think when we look overall and you look at the state of US corporates, I still think it's one of the more attractive equity markets out there. And I think this movement into Europe, I think might be a little bit overdone at this point. But dollar weakness probably has a bit further to go.
So dollar weakness has further to go, but that doesn't scare you away from U.S. stocks. Can you walk me through that?
Yeah, so I think it depends. Well, in general, when you're thinking about equities at the moment, we are no longer in an index world. We are in a world where this is a stock pickers world. Mm-hmm. And when you break down the individual performance of certain sectors, there's certainly concerns within equities. But I think particularly when you look at the main drivers, I mean, more than 50% of this rebound has been the Magnificent Seven. And they are still going to be in good shape over the course of the next few years to come. These are world-changing companies, most of which aren't as impacted by tariffs as some other companies. So it's very much picking your sectors without a doubt. But overall, I think a lot of the dollar weakness, a little bit further to go, but I think as we move into next year, we can see a bit more strength re-emerge.
Mark, do you have a question?
Yeah. I mean, the dollar weakness could be a benefit to corporations trying to sell stuff overseas, and also investors looking to put money to work over here in the U.S. So that could be sort of a positive thing from my perspective. That's why you often hear most presidents wanting to see a weak dollar, though that's sort of contra to what people would expect them to say. But certainly this president will be happy to see that the dollar's weaker, because he's been a big fan of that for a long time.
Yeah.
I think one of the big stories here is essentially when you look at foreign holdings of things like treasuries, they've been unhedged for years and years and years. And this is what's going to drive a bit more dollar weakness. We are starting to see the Taiwanese, Japanese lifers start to hedge the FX component of those treasury positions. This idea that official institutions in Asia are offloading treasuries, it's not true. But are they looking to hedge some of that FX risk? I think so, yeah.
Well, that's fascinating and important, because that continues to be a narrative that people bring up, is that there's this fear about investing in the U.S. And it sounds like to you, it's really just about hedging and not necessarily a bet against the U.S.'s growth story going forward.
No, I would agree with that. That being said, clearly there's not that much demand for duration at the moment. People do want to move down the curve into shorter tenors. But remember, those Asian official institutions, they're not holding the 10 and 30-year part of the curve anyway. Now, when you talk about private investors in Asia, yes, we have seen some offloading of the long end, but that's been just moving into the short end, which is why I think steepeners make sense in this world.
And can we go back to something that you said about large cap tech driving the majority of the S&P 500? It just makes me think about the question of what diversification looks like going forward, what healthy diversification looks like for our investor audience listening, because for a while you kind of got paid to not diversify and just bet on those 7 stocks. And then for a little bit, it seemed like the diversifiers were the smart ones because of the international exposure. Where do you net out on that?
Yeah, I still like those big stocks. I really do. But then you look at sectors that are going to be impacted by tariff, and perhaps having some shorts in those can provide that diversification across the board. So rather than just buying the index level, pick those specific stocks that are going to perform well and look to short some of these sectors that are going to be under pressure. So it's very much international focus versus domestic focus. But I do agree with the point that was made earlier that essentially April 2nd was peak tariffs. Now, 10% is going to be the minimum. We'll end up with an effective rate higher than that, but we've seen the worst case scenario at this point. And negotiations, this is going to be an ongoing story. This is not going to be over in a month. This is going to be something that dominates the whole term of President Trump. But the worst case has been seen, I think.
Mark, can I get the same answer from you on my diversification theory of like, how do you convince yourself to diversify when staying in tech rewarded you for so long, and how do you think about that versus international exposure?
Yeah, diversification today means something so different, right, than it used to mean, right? From our perspective, especially in the recent market behavior, as you pointed out, diversification could be could hold you back, right? Over diversification could hold you back when you have one sector that is clearly leading. And while we always look for diversification, it's increasingly difficult to find diversification opportunities, being that all the headwinds that are faced, being faced by other sectors. And even I was going to ask you what your second favorite sector was, because I even struggle to find a second favorite sector. I'm a big fan of the mega caps, certainly the AI ecosystem stocks. I just can't find anything at this point that offers you the same type of potential lift, and anything you're buying is not necessarily hedged as much as it is as an anchor that you're pulling behind your boat that's deeply in the sand. So
that's a good way of putting it. And I have to say, I agree with you.
Yeah. Okay. So sector number 2, also.
Yeah, I struggle with it. Look, if you are going to look for a bit of international diversification, obviously this is a consensus trade, but there's a reason that European defence stocks have performed well recently. I think there's a lot of implementation risk around this fiscal stimulus in Europe. I think there's a lot of good news baked into the euro, for example, but there is going to be more military spending. So those companies that haven't performed well for decades now are going to get a bit of an uplift there. But when you look at the European sector in general, you don't have those mega tech stocks. Well, maybe there's 1 or 2 that we can think of, but beyond that, this is one of the reasons why I still think US equities overall are going to continue to benefit. And yes, it's concentration risk, without a shadow of a doubt, but I think the future for those companies still looks bright.
Yeah, and it's hard to find a second choice. I feel like we're in the New York City mayoral debate last night when none of them would say who their second choice was, but it's hard when you got large cap tech in the room. Thank you so much. Really appreciate you for joining us, Christian. Great insights as always. Mark, we're going to have all your markets action ahead, so stick around. You're watching Catalysts. Senators are sorting through dozens of proposed amendments to the Genius Act as lawmakers push to finalize agreements. Senator Cynthia Lummis told Bloomberg that the key stablecoin bill could pass as early as next week. The talks come as stablecoin issuer Circle is set to begin trading on the New York Stock Exchange on Thursday. Kavita Gupta, Delta Blockchain Fund's CEO, joins us now. Kavita, it's great to speak with you. We've got Circle, we've got stablecoin legislation coming together in this particular moment. How good of a day is it to be a crypto investor, to be interested in the future of stablecoin?
Oh, absolutely. It's a great day. I think Circle is one of the earliest companies to come up with the whole platform of stablecoins, have also done it very transparently and credibly. We have always seen the debate between different stablecoin issuers around what is the asset collateral, right? What is the transparency around it? And Circle has always led it. So with this IPO, where not only they actually increased the stock price, everybody was expecting 26, 27, they went with 31, and it's already trading above 40 on Robinhood. It seems like it's a great day. People do believe first in the U.S. currency, and then the dominance of the stablecoin as the new payment system, which is amazing.
So, Kavita, given that optimism, are you a buyer of the Circle IPO?
I think we have been buyer of all the returns which you can make, the yields on the stablecoin for last 8-9 years. We were one of the first people to actually put all our cash from our fund and everything into stablecoins to consistently earn yields anywhere between 4% to 12%. So I think the Circle as an IPO is definitely a buy for all the public markets. As a crypto native fund, we have always been a fan of all our yields on stablecoin.
And my guest host, Mark Malik, has a question for you as well, so Kavita.
My question is around the Genius Act, which we're hoping is going to be passed this week. So a lot of the questionable things, a lot of the debates we've been happening around stablecoin and around the different producers of stablecoin. This should sort of solve a lot of these problems. So I think it's a win for the industry. But the question is then how do you differentiate one from the other? Because really these are just proxies for the U.S. dollar at the end of the day. And so why would I pick, let's say, Circle versus a competitor and the many that will probably come out of the woodwork after the act is passed?
It's a very, very good question. See, at the end of the day, we want to see a credible platform, which is on the US soil, following all the KYC, AML, making sure that it's regulated in the sense it is approved and people are really not going to lose money, as we saw with Luna, being there. So I think the Genius Act, first of all, take care of any doubt in anyone's mind to keep their dollar into a stable coin and have higher yield without thinking about, is it a fraud? So that's what gets taken care of by Genius Act. Now, the question is whether a particular companies continue to have a monopoly. I think it's all about the distribution and how do you do. Like we already have stable coins from PayPal, from Paxos. There are multiple stable coins which are done in a right manner based on whatever is available, legal rights right now available. Said that, I think Circle has done a very good job with their partnership and their distribution with Coinbase, one of the biggest exchanges in the market, and a lot of other spaces. So ultimately, it will become a distribution game. And how much collateral can you really have to be able to issue more and always be there? So there will be some advantages, but of course, I don't think over next 5 or 6 years, we're going to have a monopoly around it.
And Kavita, I also want to ask you about some news from this morning. Trump Media preparing to launch its own Bitcoin ETF, with Crypto.com filing a motion to that end with the SEC. How does the president's movement into Bitcoin with the launch of an ETF like this coming up impact sort of the adoption in the broader crypto space and any sort of investor sentiment concerns that you might have?
I think, first of all, I've always said it's amazing news that the president of United States is all about Bitcoin, is so crypto friendly and is out and about there about that. Said that, when you do have, whether it's seen, it's perceived, it's not perceived, I'm still very not sure about it, but some sort of a conflict of interest, it does create an opportunity and the confidence in it. But at the same time, the question is it everything according to law, in which everybody has the same pie, same access? Then it's great. Said that, we have seen in the past that the Bitcoin has been crossing every day in last couple of days their last highest price tags. So we do see it's going to be the era of Bitcoin, hopefully Ethereum very soon. But all these news does get me a lot of confidence in the space, with a little bit of anxiousness that the conflict of interest does not take it and make it a political statement instead of moving us financially in a right direction.
Kavita, really appreciate you joining us this morning. Thank you so much. Some breaking news crossing the wire. We are getting some reporting on the details of President Trump's call with his Chinese counterpart Xi Jinping this morning here. Taking a look at these headlines, Xi telling Trump that the U.S. should remove negative measures on China, also telling Trump he is welcome to visit China again, and telling Trump that China implemented the Geneva Agreement. That is according to CCTV. Xi and Trump did agree to start a new round of talks ASAP. Again, that is also according to CCTV. Taking a look at the market reaction, we're seeing stocks in Europe rising, turning positive for the first time today. And we're also seeing a movement. If we can pull up the major averages in the U.S., we are seeing stocks flipping to the upside. You've got your S&P up about 0.1%, your tech-heavy NASDAQ nearing gains of about 0.3%. And I think the key headline here, Xi and Trump agreeing to start a new round of talks as soon as possible. I do want to go to Mark Malik on this, who is still on set with us. Mark, what is your reaction to that agreement to continue these conversations?
Yeah, that's very positive news. But the big picture of things, as we said earlier, it's an inch forward, but forward is better than backward. But it's by no means an end game at this point, right? At this point, there's a lot of positioning happening. There's still going to be plenty of saber rattling that will happen in the days and weeks and months ahead. But all the positive news of just that they're engaged. It's not anymore about the he said, she said that we talked about. But we anticipate this type of stuff. We'll take the good news at this point.
Talks about continued talks. Mark, thank you so much. Appreciate it. We're going to continue to cover these headlines for our audience when we come back. Walmart holding its annual shareholders meeting, offering a look at how the retailer is navigating the current macro environment. Yahoo Finance's Brooke DePalma is here now with the biggest takeaways. Brooke, what are you watching?
Well, Walmart's certainly positioning itself to be a competitor or retailer of the future, and that's what they really emphasized at the start of this 55th annual meeting that just concluded this morning. There were three main areas that the company hit: how exactly it's going to compete in this future of retail by scaling higher margin businesses, doubling down on value and convenience, as well as e-commerce. And other two topics that were hit many times throughout the call with shareholders was diversity, equity, inclusion, as well as a few shareholders having a few questions around tariffs. And what we've seen in the past year from Walmart is really this well-executed team be able to double down on that higher margin business, e-commerce, value and convenience, things that consumers really care about right now. And investors certainly applauding that. Year over year, shares are up more than 50%, outpacing the S&P 500. And if you take a closer look at those two shareholder proposals around DEI, both of which Walmart encouraged shareholders to vote against. We'll get those results at the end of market close. Proposal number 8 was a racial equity audit. Shareholders calling for this to be done, and Walmart saying that they encourage shareholders to vote against it because they hire from a broad pool of candidates. They provide skill training and educational opportunities, and they claim that they do not make employment decisions on the basis of race and gender. In addition to that, proposal number 9, report on delays in revising diversity, equity, and inclusion initiatives. Now, the shareholder there hoping that Walmart will explain why it apparently, quote unquote, took an external threat of public exposure of Walmart's policies and practices for Walmart to revise its DEI initiative. Of course, many thought that Robbie Starbuck was the cause and the reason that Walmart stepped back and changed their DEI initiative to more of a belonging approach. And in addition to that, there was a question on tariffs, many of which has both investors and Main Street concerned right now. The question there was, when will prices return to normal? CEO Doug McMillon saying on the call that pricing is dynamic. They said, we've got situations where prices are coming down, but there's some situations where there's cost pressures and prices are going up. So certainly what we've been hearing from Walmart here, that prices are so dynamic right now. They're really working with their vendors to sort of get on top of this. But obviously it was a key concern in today's annual meeting as well.
Certainly. Brooke, great overview as always. Really appreciate it. Thank you so much. Some breaking news we want to bring you. Democratic Senator Elizabeth Warren of Massachusetts is calling on the Federal Reserve to reverse its decision to lift the asset cap restriction it imposed on Wells Fargo for more than 7 years. The Fed said in a statement this week that Wells Fargo met all conditions to remove the restriction required by a 2018 enforcement action. But Senator Warren is urging the central bank to immediately reverse its decision. In a letter to the Fed that she is sharing exclusively with Yahoo Finance, she is calling it an embarrassing and unwarranted decision. The lifting of the asset cap is seen on Wall Street as a win for the bank, as it can now pursue growth opportunities. But as a reminder, the bank initially facing the restrictions in 2018 after regulators grew frustrated with the bank's slow turnaround to clean up a slew of scandals that began with fake accounts across its branch network and later multiplied across business lines. Still with me on this, we've got Mark Malik, Siebert Financial's Chief Investment Officer. Mark, your reaction to Senator Warren's letter?
Well, she's doing her job, and she's certainly voicing the other side of the opinion. But from the perspective of regulators, Wells Fargo has been doing a great job at managing their business in the wake of those troubles that they had early on. The bank is on solid footing; they've demonstrated that, the voters spoke. They're looking for less regulation, right? So this is one of those small steps that are sort of less regulation, allowing a solid American company that has been doing the right thing to do what it does best. So, that she's doing her side, but that's certainly a very positive thing. Not her letter as much as the raising of the bar.
Yeah, especially for those who are invested in Wells Fargo. We saw the stock popping off the back of that asset cap lift this morning, seeing a little bit of declines there. Well, I want to bring you an update on some breaking news with the U.S. and China. We are getting some reporting on the details of President Trump's call with his counterpart Xi Jinping. The U.S. president now weighing in on the call in a post on Truth Social. The president saying he had a very good phone call with President Xi of China, discussing some of the intricacies of the recently made and agreed to trade deal. The call lasting 1.5 hours, resulting in a, quote, very positive conclusion for both countries. Critically, he points out there should no longer be any questions respecting the complexity of rare earth products. That's something investors have been keenly watching. Respective teams between China and the U.S. expected to meet again at a location that is to be determined. And the president saying thank you to President Xi for his attention to the matter here. So again, some of the key headlines here: no more questions on rare earth products with China, and also they are expected to meet again. So the talks on trade continuing. Mark Malik still here with us. Mark, what is your take on the rare earth commentary specifically and the continuation of these talks?
Yeah, that's good news. So earlier we said maybe an inch forward. That's maybe 5, 6, 7 inches forward. That is obviously one of these key topics that was one of those friction points. It's good that they're talking about that. This type of messaging from the president seems more controlled and sort of information versus reactionary, which also sends me a sort of a side message, which is they're moving this forward, they're doing business, and that makes a lot of sense. It's not an emotional reaction, but they're moving forward. So we'll take that as a positive as well.
Yeah, and it's interesting as well to hear them talking about kind of the continuation of these conversations going forward, and that the call was very specifically about trade. They mentioned that they didn't talk about Ukraine and Russia. They also didn't talk about Iran. So really highlighting what the market is also focused on, which are these trade deals. When we take a look at the major averages, we are up at the moment, but not by much. Is this a symbol of what investors should anticipate going forward when we get trade headlines, that it's not going to be this huge mover?
Yeah, I think we've already shaken out all of those, all of those big moves at this point. We know the meats and the bounds of everything, right? We know the worst case scenario, and we're aiming for the best case scenario. And as we said earlier, I think the market is expecting this to be sort of a drawn out discussion, something that maybe, if we're lucky, we'll get some sort of real resolution by the end of the year. But at this point, right, this is sort of fitting in with that narrative. So we're not going to see these big pops.
Yeah, and one piece of legislation we've managed to avoid this morning in our conversation conversations is the tax bill. To what extent do you see that as a potential catalyst for the market?
Yeah, that could be a huge catalyst for the market. Any way you look at it, if you just put aside the deficit question for a second, and you just look at what's in that bill, that is definitely stimulative. I think the market will receive that very positively.
Yeah.
The market is expecting something like that, but I think once we get something like that passed, I think we can start to see some definite real benefits to the companies behind the stocks that we buy later this year as some of these things start to take effect and so on. So very positive.
Mark, really appreciate you joining us for the hour and giving us so much of your insight. Thank you so much for your time. I do want to take a look at the major averages. As I mentioned, we've got stocks in the green across your screen, though you got the Dow flipping to the downside just a bit. Here your S&P is up about 0.1%. Your tech-heavy NASDAQ up 0.3%. Taking a look at the, apologies for that sound, everyone. We are okay in here, but taking a look at the sector action, you've got comm services as the biggest gainer, and you've got tech as the second biggest gainer on your S&P 500. All eyes on Broadcom's earnings. They are set to report after the bell today. Interesting to see Nvidia and Apple moving to the downside this morning. Coming up, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith has you for the next hour, so stay tuned for more.